Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in tonight's video, I want to go over our two opening trades that we had to kind of kick off the new week for Monday, March 23rd. So again, we just had two new opening trades. Both of these trades are bullish. When we did the strategy call last night with premium members, where we go over all of our positions and kind of the strategy for the week coming ahead, we realized that after we had gone through expiration and cleaned up a lot of the positions that we had some positions expire, some positions we closed out, some positions we rolled, our basic portfolio was left a little bit tilted bearish. And that's not to say that's a bad thing. You can be tilted one way or the other, but we definitely want to have a little bit of rebalancing going on this week. And part of that is going to be entering some bullish positions as we get into the start of this week, today, tomorrow, and the next day. So we did enter a couple trades today, just two trades. One is in Facebook. So in Facebook, we went with the vertical call spread, and we did this, the 82.5/85 debit call spread for a 128 debit, which means that our max risk is about 250 on either, or the width of the strikes is about 250, and we paid a debit of 128. So that puts our risk to reward about 1-to-1 for Facebook, which is a really good trade for us. And directionally, we're just playing Facebook a little bit higher because it's moved out and broken out of pretty much the range that it's been in. It's definitely moved above 80 and on some pretty strong days where it's closed continuously higher. And we got a good, nice signal in MACD that says it could be moving higher. So we're going to play just a little bit directionally bullish. We don't know for sure if it's going to go higher, but that's exactly where we're going to play just based on the signals that we're getting. Now, the reason that we went with, the reason that we went with a debit call spread is because implied volatility is at one of the lowest points it's been all year in Facebook. You can see implied volatility is down in the second percentile. Now, we did a good job last month trading Facebook with a calendar spread and had some really nice income with Facebook, even though implied volatility stayed low. But in this case, we already have some calendar spreads that we have on and working. We entered a calendar spread in IWM last week, so we wanted to diversify the strategies that we're choosing and add a debit call spread to this position. Now, this basically gives us a profit and loss diagram that looks like this. Very, very simple debit call spread. Anyone can do this in any account. Again, profit and loss diagram is very, very simple and easy. And again, about 1-to-1 risk reward, which means that every dollar that we could potentially make, we have a dollar up at risk. But what I like about this trade already is that our break-even point is right here, about 83.25, and Facebook is already trading at 84.45. So we've got a little bit of embedded edge here, a little bit of built-in buffer that Facebook could actually go down a little bit and we could actually make some money on this trade. But again, we did this thing small as always. The other trade that we did today, because we do have extra available capital in our account right now, is a naked put in rig. So we did sell one rig. It was the May contracts, the monthly contracts, and the 12 strike puts for a 50-cent credit. Now, we already have a position in rig, and rig has really high implied or fairly high implied volatility right now. It was up in the 60th percentile today. It actually came down just a little bit, but we think that it's definitely creating some sort of a base at this point. Now, whether that's going to materialize between now and expiration, we don't know. It could definitely move lower against our position, but it's about a 20% plus drop from where the stock is currently trading right now at $15.32 down to our strike price, just our strike price at $12. Remember that we took in a 50-cent credit, so our break-even point on this is about $11.50. So rig would have to move down about $4 and some change before we actually lost money on this trade at expiration. Now, even saying all this, we obviously did the position very small. It takes up a little bit of additional margin, but we also did have a current position in rig already. So here's the position that we had in rig already. This was the April's kind of skewed iron condor. We were skewing it to the top side because we thought that the risk is that the market obviously rallies a little bit faster than it's going to fall at this point, given how fast oil has come down over the past couple months. And so what we did is we added just a single naked put to this strategy, and this really pretty much reduces or minimizes any upside risk that we have at all in this stock. So by comparing these two or putting these two together, through April expiration, we basically have no risk to the upside if rig does for some crazy reason shoot through the moon and oil rebounds really, really fast. So again, we needed some bullish positions in our portfolio. This fit the mold for us. We would have liked to go with something like USO, but didn't feel like we could get enough premium for just one single naked option as we could for USO with about $50 for that contract. So again, I like the position that we have in rig, and it was pretty nice to get some good premium in here. It should be very easy to get in and out of rig. Fairly good liquidity, fairly wide markets as far as depth and strike prices, so you shouldn't have an issue at all getting in or out. As always, hope you guys enjoy these videos. If you have any comments or questions, please ask them right below. And until next time, happy trading.